Hello everyone, this is Popeye and today we are sailing together to the Old Wild West for the good, the bad and the ugly YouTube series. A video collection where I will evaluate some of the past trade that I took in the previous days in order to check the why, the what and the how behind this trade, in order to pick one good trade, one bad trade and one ugly trade. We will evaluate together this trade to see how I can improve on my trading journey, but also I will try to give you some tips in order to grow in your path to become a profitable trader. So stay with me here in the Wild West for the good, the bad and the ugly YouTube series. As always, big shout out to Bluefin for sponsoring my YouTube channel. Make sure to trade with me on Bluefin. You will find the referral link on the description below. And before moving to the good, the bad and the ugly, also make sure to subscribe to the YouTube channel, and at the end of the video, if you enjoyed, make sure to leave a comment and a like. But without further ado, let's go to see the good, the bad and the ugly. So as a good trade, I picked for this week a Solana trade that I took at the beginning, I think, of last week, and was a trade, let's say, that was very clean and was a trade that respected many of my criteria for taking this specific short. So if we go to see on the chart, we can see that before opening the trade, just to give you the context of the Solana price action, we did have on high time frame a very clear downtrend. As you can see, the price is clearly moving down in a series of lower highs and lower lows. And also we can see that more or less all the little sideways price action we had had a sort of distributive pattern with some sort of deviation, and then price started to move down. As you can see, we always have this sort of distributive pattern where the manipulation is happen on the top of the range, as you can see also here, on the top of the range, and then price start to push further down. So the bias generally on high time frame was clearly bearish. Then since few days, I think since mid of November, we can see that Solana started to move sideways horizontally, creating a very clear resistance zone on this level within 144 and 146. So it was a, let's say, both in terms of bias on a time frame, bearish because of the downtrend, and also we reach a very key level that was a resistance level with a lot of equal highs to be swept. How did we reach that level? So for me, this was a key level, and I was really interested to do business at this level. But I didn't want to short it blindly. I wanted to see how the price would have reached that level. And there were, I would say, three important components of the price action preceding the visit to that level. The first important component is this very big gap that we created on the way up. So usually this sort of gap tends to be filled, as you can see here. Partially filled, or as you can see also the other way around where they get filled. So this for me was an interesting level potentially for a reversal trade, because there was no support zone on this level here. The second very interesting component is the fact that we move to that resistance clearly with a super clean 3 drive pattern. That is one of my favorite pattern when it comes to a reversal trade. So if the price move in this sort of formation with this very, very clean 3 drives, and it goes against a resistance level, a supply or sweeping, in this case, like this case, a lot of liquidity, it's potentially an interesting pattern to play a reversal on the other side. You will find on my playlist, the Learn and Trade, a specific video called the Trade Drive pattern, where I specifically explain how I trade this pattern. The third component was this very clear bearish divergency on the 1 hour, happening on clear over both territories, so at the extreme level of 85, and you can see clearly the price was forming a series of higher highs while RSI was losing momentum and forming a series of lower highs. So these three components are super important. Let's say these four components are super important for any trade reversal. So trying to fade this bullish momentum and trade to the other side. So we do have a clear range, we do have a clear resistance level, we are clearly in a high time frame downtrend, and we reach the key level. So if this sort of pattern would happen somewhere else, would be less important in my view. But since it was happening exactly at this level I was waiting for, we also got the tree drive and the bearish divergence on RSI. So what was here the trigger, since we saw all these happening at the same level? Initially, I think I posted on X that I was potentially waiting for a 1 hour market structure break that would have been here down. Then the problem is that this is a range trade. So in any range trade, the priority for a short is to short as close as possible to resistance. So as close as possible to this 104, 144, 145 level. So waiting a 1 hour market structure break, you can see that we are already getting very close to mid-range. That is an area where short would be having a very bad risk reward, because the entry would be there. That's why I posted live on X that I was going for a 15 minutes market structure break. I also posted in this post the pros and cons of going with a low time frame instead of a higher time frame trigger. But as soon as price started to break on the 15 minutes, let me make it more clear, this was the 15 minute structure. As soon as the price started to break down on this 15 minute, I opened the trade, I market opened the trade. So I didn't put a limit order, but I immediately opened the trade. And luckily, the price started to move down and down. And as you can see, if I would have waited the 1 hour market structure break down here, the bounce here would be have been really minimal, and probably all the possible short would have been too late to execute or not be filled somewhere here. So for me, in this case, there were a lot of confluence to open this trade, as I explained: the bias, the context, the tree drive pattern, the momentum stalling on RSI. So it was a positive trade to take. I put my final take profit on, let's say, the confluence of two levels. And one was the range low, this big red line, because in a range, once we short range high, the final expectation is range low. It was, as I explained in the beginning, also a level where we would have filled completely the inefficiency we created on the way up. So this was an easy area to be sliced through. And to add some confluence, I took the Fibonacci of this, let's say, bullish move on the way up, and the 0.75 level was exactly there. So target was completely smashed. Very nice clean trade with zero drawdown. Since opening the trade we moved down, and also very nice to see that the moment this was in theory, let's say, a 4-hour trade looking for a 15%, 10% move down, as soon as the target was smashed, you see the price basically basically bounced almost 9%. So would the taking profit would put in another place, here the risk of round tripping would be very, very, very important. So I'm really proud of this trade, especially for the reading of the context on high time frame, for waiting and executing flawlessly at the level I wanted to see, after seeing what I wanted to see in order to trigger a short, and also not to be afraid of opening the short just with a low time frame trigger. Also very proud of the final take profit placement, because it was very clearly the right place with the confluence of these three aspects. So the good for this week was Solana, a very good trade. I banked a lot of profit on it and was really a well planned trigger and executed trade. The second trade I want to show you this week, the bad, is a trade I took on PENGU. This was also a short trade that I did profit a bit from this trade, but after I was stopped at break even after securing a mere 1.3 R. So even though this is a successful trade, I think was not a very, let's say, well planned or well traded trade from my side. Basically for a few reasons. So if we go again to see the context, we can see that also PENGU is clearly downtrending. We have a clear and very well established downtrend with the price breaking low, deviation here above, and then further breaking down, and now here we start to go laterally. Somehow very different, but also kind of similar from the Solana trade. So what was here my concept? That we started to go laterally. We did have, you can clearly see that we started to go laterally. We did have a deviation in this range below, and now potentially we are a deviation above. So in this case, was, let's say, because of the high time frame bearish bias and because of this potential range deviation, a good, in generally a good short. Similarly to Solana, also here we had a very big inefficiency to be filled, and as I said, this tend usually to be filled. So whenever I see the lack of a support level, a short is a good idea, usually because then you can expect the price to go down. So I took profit along the way here down, and then I move, after I took profit, I moved stop loss at break even, and I think on this bounce here I was stopped out at break even after securing that little profit. So a few considerations why I think the execution here was not well done. So the first problem is that similarly to Solana, I opened the trade even before a proper market structure break, because I was expecting a quick filling of this inefficiency. But the difference here with Solana that we got this bounce. So as you can see, while the Solana trade was very close to range high, this trade is already starting to be pretty far away from range high, and the following price action shows that I could have taken a better entry, probably with some Fibonacci retracement, probably from here to here. As you can see, the entry would be a sniper entry here if I would have waited this market structure break on the 1 hour, place a limit entry at range high, exactly at range high, at the 0.75 level. The trade would have had a much better risk reward, and the entry would be much more favorable. So in this case, the negative judgment I give myself is the fact that I impulsively opened this trade where I could have probably waited for a proper market structure break and then a bounce back to range high. As I said at the beginning, the scope and the goal of any range trader is to try to exploit the range extremity, so range high and range low, as close as possible for a reversal to the other side. In this case, you can almost see that I'm midway from mid-range, that is this level here, and range high. That's why the risk reward was not so favorable. Then the evolution of the trade, I don't have many comment on this. I took some profit on the way down. The trade never came down exactly to range low, and basically PENGU started to be really choppy here at mid-range. You can clearly see that there was this fast decline, and then price now is starting to slice through mid-range. So I would say that I'm happy that I moved my stop loss at break-even. I got out because when the price start to do this stuff, to me is pretty unpredictable where the next level would be moved. So again, a profitable trade, not a good one, a bad trade for me because of the poor lack of patience and the poor execution on the entry. I could have entered in a higher level. So the bad for this week has been PENGU. Now let's go to the last one, the ugly, and this a hype trade. So this will be a little bit complex. So hype trade was basically a continuation of a trade that I opened last week, 2 weeks ago. So I shorted already this trade at the beginning with a very nice risk reward. I already took secure around 3R profit on the way down here, and then price started to bounce back. I had initially planned this trade to add to compound to this trade because of the context and because of several reasons on the hype trade. So what I will judge this week is the second trade I took on hype. So let's see a little bit the context as always to see the bias. To me, this is a clearly, you can see very clear uptrend in the past months on hype. This uptrend is starting a clear distribution with a huge deviation above. Price start to break down, go again against range high, fail to break, consolidation, and then this massive break range start to break down. Contextually, for me, this is a very interesting for a bearish continuation, because when there is a strong uptrend and then a very long from July until November sideways price action like the one we had all these months here for 4 months, once this big consolidation phase start to break down, I have the confirmation that this was a very big distributive phase. So a very big distributive phase for the concept of proportionality, to me, open the gate to a long downtrend move. So more or less here we had a long accumulation phase resulted in a long uptrend. Long distribution phase open the gate for a long distribution. So I was super interested. I shorted many times hype in the last few weeks. So I was very interested to expose myself, let's say, aggressively on this short. So the first trade I took was a successful trade, potentially around 7R. I secure because of the partial around 3R. Somewhere down here, the price start to bounce back. So I wanted to add 1R risk on this trade, so I would have the 2 positions running, and I'm not sure why I decided to go very blindly with more or less this range. Let me show you a little bit better on the 1 hour. On this range here, you see this was the establishment of this range. So for me, this was an important resistance level. Once I saw this swipe here, this sweep here of this range high rejection, there was a not very clear market structure break. So I entered the trade in this little bounce here. As you can see, very, very precisely, the previous trade I had the stop loss at break even. So probably because of misjudgment and hurry, I put both stop loss at the same level. So the first trade would have been stopped at break even, and the second would have been stopped for a 1 hour exactly at the same level. As you can see, the price goes up exactly to take both my stop loss, one at break even, one at 1 hour, and then the trade finally go down to the final take profit of the 2 trade. This would have been, if I was not stopped out, a massive trade in terms of risk reward. Probably I would secure around 6-7 hour if properly executed. So In insight, I see the mistake I've made here, but I think this price action it was a little bit wild because I don't have any reference level to have that entry. As you can see, the 0.75 of this move was around this sweep here and was okay with my entry, but it broke the 0.75 and it started to go down. So probably even with the Fibonacci, I would have taken probably this trade here, move the stop loss a little bit higher, not sure 100%. This move above, it's very particular. I saw this bearish divergence forming here, but as you can see, also this was a bearish divergence on this last high above. Probably or I should have not take the second trade, but was in my plan, so somehow I stick on the plan, or I should have waited for a further move up. Or the third option, to make it, to try to find a different way I could have traded this, I should have leave both the stop loss at the original place that was above this high here. In this case, both trade would have gone to final take profit. But overall, let's say it's a little bit strange price action for my view, what was developed. I know the feeling that I had when I opened this trade. I was in a bit in a hurry. So there was a very strong planning of this trade before when I opened the first one, but the second position I was a little bit not really deep focusing on the way I should execute this. So I think this kind of trade, especially in a clear downtrend, are the way to go. So to compound on position as the price keeps going down, to add at every bounce and keep shorting the downtrend, because it's a very clean and established downtrend. As you can see, IP still forming lows and is still pushing lower below even my final take profit, but probably need to be a little bit more careful on the execution, especially because this sort of coin, as you can see here, can bounce, can have this very strong dead cat bounce that can stop you out. But I think is everything for this week. Before a little summary, as always, make sure to supporting by trading with me on Bluefin. You will find the referral link on the description below to enjoy a 20% discount on trading fees and to be eligible for all the campaign I'm sharing in the Telegram channel that the Bluefin team is tailor-made for us. Bluefin is a non-KYC exchange, so super easy to join without the need of sharing any personal information. You just need an email address. It has a lot of liquidity and a very cool interface. So do not wait further. Go in the referral link in the description below and enjoy trading with me on Bluefin. So little summary. Wait the level, I would say, here on Solana. Wait for the level that you deem important to do business. Do not make business in levels that are not interesting. Simply put, in a range, try to short range high, try to short range low. Also another lesson, wait for trigger, but do not be afraid to take strong action, especially in a very high confluence trade like this one in Solana, where the 15 minutes trigger, bearish market structure break, was more than enough to enter the trade. Also, context is important, bias is important, trigger for opening the trade are important, but also you have to have a target, a clear and logical target for your trade. Otherwise, as you can see, if the target in this trade was placed in a wrong way, very easy to, especially in a range, to be front run aggressively. For the PENGU trade, generally this kind of meme coin have a kind of a weird price action, so probably I should be aware of it when I trade them. Be more patient, wait more for range high and range low level. Try to avoid doing business like I did here, so midway from range high to mid-range, because the risk reward is not favorable. And do not always be aggressive with market buy. Just place an order whenever there is a market structure break on Fibonacci and close to range high as possible. Hype trade, lesson learned, I don't know, be more generous with the stop loss. Probably if the stop loss would have been like 30 cents above, I would have been safe, and probably focus always more and concentrate on the trade, as I did in the first 1 year that I was really focused. Probably in the second trade I was not that focused. I think is everything for today. I really hope you enjoyed this new series, the bad, the good and the ugly. If you enjoy, make sure to leave me a comment and a like here in the YouTube channel, so I will know that I will record at least one episode every week. As always, stay safe out there, and we see you on the next one. Bye, take care.